Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Paul from the SiriusReport.com. Paul provides daily podcasts on finance and geopolitics and exclusive analysis and intelligence. You can go to his website. I subscribe. It's only about $1 a week, and you get some great analysis from Paul. Paul, welcome back. How are you?
Yes, I'm very well, Mario. How are you?
I'm well as well. And Paul, just before we start, could you tell the viewers, especially the new viewers, they might not be aware of tell them about your background?
Yeah, sure. I mean, obviously, we'll go back. I was originally a physicist. I was an academic for a short time and kind of realized that I didn't want to be institutionalized in the academic world and kind of moved into a very radical departure in some ways into the world of finance and worked in a whole bunch of banks doing all sorts of things. And I was quite fortunate that there was institutions who went, well, we don't know what, we think you've got an interesting profile. We're not sure where to stick you, but we'll hire you. And then the rest is history. But of course, like a lot of people, I became kind of fed up with financial institutions and what was going on in 06, 07. We talked about recognizing that there was a global financial crisis in the making. Of course, it happened in 08. And for me, that was the time to go. So I left at the back end of 2008. Then I worked with friends in mergers, acquisitions, all that mining space. And then sort of for a whole bunch of reasons that aren't really of any interest to anyone, it got to the point where I couldn't continue doing that because of all family commitments and things. And then started doing the podcast because I went, well, it's something that's of interest, and hopefully other people will find it interesting. And here we are, just over 6 years later, still doing it. I didn't really have any expectation as to how long it would continue, but we're over 1,560 odd episodes. We're still doing it, and it's growing and expanding. And I do think we offer value. We have quite often a different perspective to a lot of people, but we also integrate really the ongoing birth of the multipolar world, the predictable demise of the unipolar world, and how that interacts economically, financially, and of course, geopolitically.
Great. The other thing I would say to the viewers, if they're on Twitter, to go to @theseriusreport.com. I think Paul is very active there. He's got like 108,000 followers. So I highly recommend you follow him on Twitter. And Paul, as we speak here, we've got US GDP for the third quarter coming out in about a minute. Of course, the first and second quarter GDPs shrunk, and now it's expected to come out like at 2.5% or 3%. But moving on though, I really wanted to speak with you about the UK, because the last time we spoke, I don't think we spoke before the whole thing broke down. And even though I was not surprised by it, it was quite sharp. We saw the pound drop to like 103 versus the dollar. We saw gilt yields accelerate higher, and we had, of course, the pivot by the Bank of England to do QE, and almost meltdown of the defined benefit pension system in the UK. So what I wanted to ask you is, were you surprised with the crisis? And the second part, I guess we could talk about later on, is what do you think the new prime minister and the new government, will they solve anything, and how optimistic you are about it?
Yeah, okay. Well, it's a great subject to discuss. Maybe we can just put a bit of, I wouldn't call it historical perspective, but a bit of an understanding of what caused the problems in the UK pension funds. Now, it was kind of ironic that I think it was probably 6 weeks before this problem blew up in the UK pension sector. I actually did something in my own podcast highlighting the very risks of the so-called liability-driven investments, or LDIs. Now, whilst I envisaged it to be a problem, I didn't necessarily expect it to blow up 6 weeks later. But of course, the mere fact of highlighting it and understanding is something I'm always looking for things that could potentially be a problem. And as we know at the time, due to this wild gyrations in gilt yields, obviously this caused an enormous problem. So the Bank of England, as we know, intervened on multiple occasions in terms of the UK government bond market on a short-term basis to rein in gilt yields, because, of course, this came on the back of the sort of Truss Kwarteng idea that we were going to have all these tax cuts funded not by borrowing but by money printing. I mean, they can call it borrowing as much as they like, but it would have been money printing. Of course, the market had an absolute aneurysm, and with some justification. Of course, the fallout for the pension sector, from my perspective, isn't justified, because, again, it's another example of ridiculous leverage and margin that shouldn't exist in any sector. But of course, as we know, that's how the financial sector operates. But what this whole sort of pensions debacle did is sort of shone a light on these LDIs now, which is liability-driven investments. So the premise is that if you have a look at pensions, they have to make sure that their assets, such as stocks, bonds, or whatever else, can generate enough cash to meet liabilities, meaning, the monthly payouts that they guarantee to pay to pensions. That's the principle, at least. So the LDI was popular among asset managers who used derivatives, that thorny problem, which was to match, apparently, at least, assets and liabilities. So there was no risk of any shortfall in money to pay pensions. The fact pension funds operate this way, for me, is completely ridiculous, but we're talking about what it is, not what it should be. Now, to put all this in context, LDI was, in monetary terms, if you go back about a decade ago, was about £400 billion. It's quadrupled within a decade to 1.6 trillion. And it could be pounds, it could be significantly higher, we don't know. So the argument of how it's supposed to work is that pension funds are supposed to post cash as collateral against these LDI derivatives. And in case, of course, they turn sour. Now, of course, the amount of cash needed is going to fluctuate in comparison to the value of underlying assets tracked by the derivatives, which is supposed to be this kind of insurance against unexpected moves in the market. Well, when you suddenly have very large gyrations in bond markets in terms of gilt yields in a very compressed time frame, it therefore triggered all these emergency collateral calls for pension funds to cover these derivatives, literally in the blink of an eye. We're talking a matter of hours or a day, 24 hours, because rising yields saw the value of bonds fall sharply in a very compressed timescale. So the problem is pension funds couldn't find the cash in this very compressed timescale. So they were forced to sell gilts. It put a lot more pressure on the bond market, which is why I think the 10-year, correct me if I'm wrong, the yield rose to nearly as high as 5%, or maybe it's a bit over 5%. But anyway, it was a significantly sharp increase. So because of all this instability, the Bank of England, on a temporary basis, pledged to buy gilts. I think they said up to 65 billion. I think they did it up to about 11 billion. The irony is they were so annoyed with the UK Treasury, they basically forced the UK Treasury to put the bill for the 11 billion pounds that they'd pledged effectively to try and create stability and take some heat out of the pension funds. Now, the question is the problem solved? And from my perspective, it isn't. It might be on a temporary basis. And of course, the Bank of England have said they're going to halt the bond buying, or they did on the 14th of October. because the idea is, well, by then you should have sorted the problems out. But does it mean the problem can rear its head again? Absolutely. Now, the argument is, why does this matter? Well, apart from the obvious reasons, is pension funds, I mean, we're back to this, it's like a buoyant housing market somehow is seen as a sort of cornerstone of the economy, even though it shouldn't be, and pension funds are the same, because the theory goes, of course, they hoover up huge amounts of stocks and bonds by companies that need cash, because everyone constantly needs to raise cash to operate. Just to function, they need more and more debt. Otherwise, they go bust. Such is the way our economy and financial system operates. So, in principle, as ever, these LDIs work when everything's functioning okay and there's not huge amounts of instability. But suddenly, when you get wild gyrations, the risk is it would have blown up pension funds, creating contagion problems, which could have then spread into the wider financial sector, and not just, of course, inside the United Kingdom, although the exposure in the US to LDIs is significantly less. But we're now starting to find out that the exposure in Europe is greater than we anticipated. No surprise there. So, whilst the perception is that this sharp gyrations in UK gilts was a rare event, doesn't mean it won't happen again. And therefore, the risk is some other event. It doesn't have to be some ludicrous fiscal policy decision made by the then trust government, of course, which no longer exists. It could be something else. And therefore, it can create significant contagion problems and also blow up some other sector, not necessarily just pension funds. And the argument, therefore, is on the back of this that Bank of England, who, if I was aware of it 6 weeks before, must have been aware of it, but seemingly are only ever aware of something after it becomes a huge problem, because it's one of those things, as long as it works, no one thinks it's a problem. Until it doesn't work, and then it's a massive problem, and then everyone starts running around like headless chickens and blaming everyone else for the fact that it could have blown everything up in the process. But most certainly, there needs to be far more scrutiny as to how these LDIs operate. You may have to ensure that those holding them have to have larger liquidity buffers, because the idea that this is a one-off shock, given everything else we know about the financial system, what we know about bond markets, equity markets, etc., it's just a serious kind of warning shot across the bows of, look, it doesn't take much in the current environment to blow something up. But we're back to this point on a fundamental level. There is way too much leverage, way too much margin. And things are just operating on the basis that, well, everything's okay, provided there's nothing adverse happening. The second something does, it highlights why the entire financial system is completely mismanaged, is not in any way, shape, or form fit for purpose, as we know. And this was just an example. And it, in essence, yes, it took a rather ridiculous fiscal policy decision, but it very quickly highlighted just how rapidly confidence can be lost, not in bond markets, confidence can be lost in the currency. We saw the pound nearly reach parity with the dollar. And very quickly, there was just no confidence in these markets. And that shows just how fragile the entire financial system, and not just including pension funds, is. And despite all the bravado to the contrary, that everything's functioning fine, and yes, we've got some challenges, but it's not a major problem. It is a major problem, and I don't doubt if the Bank of England hadn't intervened, then this could have become a far bigger problem, which could have then become a contagion problem and a more systemic problem. And then, because as all the banks and effectively the Western financial system, incorporating North America and Europe, etc., are all lassoed together, it could have quickly spread into a big problem, which is why the IMF were having an aneurysm, the US Treasury were, the Fed, the ECB, because they all suddenly saw the writing on the wall over something most people weren't even aware was potentially a problem. And really, in reality, it's just the tip of the enormous iceberg, which is the entire Western financial system, is hanging on a permanent knife edge. And tomorrow's LDI could be something very innocuous, but it could equally be as devastating if something isn't done to rectify the problem. Okay, it doesn't solve the problem. It doesn't fix anything, but it's a temporary kind of stopgap put in place. But it shows as well how easily just governments can come out and make comments and make statements which, okay, we're completely ill-advised, we're actually ludicrous, and ultimately, of course, contributed to the demise of Truss, who was the prime minister for 46 days or whatever it was. It's a miracle it was that long, but it does highlight a whole bunch of problems that you've discussed for a long time now, and obviously I have, and we've discussed these kind of things together before.
Yeah, and you spoke about like the fact that these things happen and no one sees them coming because as long as things are working okay. And I remember just as the crisis was kicking off, the Bank of England actually said, "Oh, in our stress test, we couldn't foresee this." So it just goes to show as well, like how these stress tests are pretty much useless because they use equations and formulas, and they don't they don't legislate for human action and human emotion. And one thing about these LDIs, I was actually contacted. One of the viewers sent me something this morning, and I hadn't seen it, and I'm not sure if you've seen it, but this was out in the FT on October 25th, and it said pension lawyers rewrite contracts to prevent another sell-off of gilts. So they say action taken after funds were forced to dump UK government bonds to raise cash for margin calls. So what they're saying here is that they're rewriting the contracts for these pension funds to use gilts as collateral instead of cash. I don't see that solving the problem. What do you think about that?
Well, no, absolutely. I mean, potentially, but again, it's one. Yeah, it might work, but when it doesn't work, it will spectacularly fail. And if let's be honest, the whole problem came about because of the enormous volatility in gilt markets. Well, there's an enormous volatility in gilt markets again, and related to pension funds. How exactly is that going to be regarded as viable collateral? It isn't. I mean, it sounds great in principle, but again, you shouldn't fundamentally be running a pension fund that requires this kind of constant band-aid in case, that they can't meet their liability. I mean, and we know that the stresses in the financial system are there on a permanent basis now, and they can paper over, cracks to some degree, but not in reality. So therefore, the risks are enormous. They're ever present. They're only growing. And therefore, when you have to set any aspect of the financial system, be it the pension funds, against that backdrop, then the whole notion should be, hang on, why are we having this problem where we have pension funds that are geared in such a way that actually they might not be able to meet their liabilities on a monthly basis? So we have to put these measures in place that are absolutely fraught with danger. Could blow up the entire pension fund and funds, and in the process create an enormous contagion effect, not just inside the UK, but in a broader context throughout the Western financial system, given the notion is that LDIs are now they've ballooned, as we said, in the decade. And maybe they're considerably higher than conventional wisdom suggests. I mean, there's figures going back, as we said, 400 billion, roughly, pounds in 2011 to 1.6 trillion a decade later. But that's a guess. It could be 2 trillion. It could be 2.5 trillion. We don't know. Why are we allowing pension sector or the pension funds to operate the way they do? And that's a far more fundamental question, and you can't resolve that in in a discussion, but it's something at some point someone's going to go, hang on, we need to be having a really serious discussion about how pension funds operate, and they're not trying to paper over cracks or the risk of a mismatch between assets and liabilities, given particularly everything that we're now witnessing and the volatility we're continuing to see in equities, bond markets, interest rates, etc., and what that means in a broader context, not just for, solely for pension funds.
Yeah, I think the fact that we've had this policy of zero interest rates up until recently is one of the huge problems behind the pension fund industry, because instead of being able to get 6, 7, or even 8% return from government bonds, they haven't been able to get that. And ironically, though, or paradoxically, um, the only way to resolve it, in my opinion, would be to allow interest rates, government bond rates, to rise a lot more than they are right now. But that in and of itself caused the whole problem. So it's a really tough question, like you said. And just to finish off here about the UK, and then maybe we could move on to the US Treasury market. But I don't know if you noticed, you probably did, that the UK Chancellor, the new Chancellor Hunt, he's delayed his autumn statement, I think, till the middle of November. Um, do you see that as a problem? I mean, if everything was stabilized or okay right now, why couldn't he come out? And the other part of the question I want to ask you is there a solution to our debt problem in the UK?
Well, the first point with regards to delaying this fiscal statement, which was supposed to be in October the 31st, and now it's supposed to be November the 17th. Yeah, there should be major alarm bells going off. I mean, there's claims there's a shortfall in UK finances, which could be £35 billion. It's probably nearer 100 billion, but they'll never admit to it. I mean, this is supposed to be based on available data, whatever that means, because we know available data is about as useful as chocolate fireguard. But the statement goes, the Treasury's drawn up these over 100 options to cut spending. I mean, we're going to cut spending at the worst possible time in this economic financial cycle. We have a cost of living crisis. And ironically, of course, we have enormous problems created by the then Chancellor Sunak, who allowed just endless money printing, which, of course, has been a huge contributory factor to all the ongoing problems we're having. And then for him to become prime minister and go, oh, we've got all these problems. Yes, you contributed directly to it, the large part of why we have these problems. But the idea we can cut spending when we have a cost of living crisis, that we're going to hike taxes where people can barely afford to feed and heat and light their homes, etc. And raising interest rates, of course, means, particularly in the UK, with people having short-term mortgages for 1, 2, 3 years, they're having to refinance them at much higher rates. They're having problems in that regard. And, we just compound all these problems. And somehow we're going to now go into this policy of massive austerity when austerity never works anyway. And it particularly won't work when people are already struggling. You're just going to make that problem infinitely worse. And whilst there seems to be a recognition in some quarters that societal unrest is a huge problem in the making, they seem to be living in cloud cuckoo land and think that this doesn't apply to them, that, that somehow we're going to get around this problem, this enormous shortfall and in our budget. And what does that mean? The NHS is crippled and it's massively underfinanced. Okay, there's a lot of wastage, but what are we going to do? Have cuts in NHS spending when the NHS is basically on the verge of collapse because of completely stupid sort of pandemic policies that have created these enormous waiting lists with millions of people waiting for treatment who should have had it a year ago, 2 years ago, whatever. So the other interesting thing is by pushing back this statement, probably because they don't really have a clue what they're going to say and they know how unpopular it's going to be. The delay means the Bank of England's going to have to make its next call on interest rate, having no idea in principle at least about the UK's financial position, and because bear in mind they were furious with the Truss government coming out promising the earth with printed money. Now there's the reverse going. What are they going to do? Have austerity on steroids? And what are we going to do in terms of making interest rate policy decisions? This isn't defending the banking. This is just a statement of fact. Now the argument is, and I think there was something that came out in the FT which said to reassure markets, in inverted commas, the government's got to keep its promise that public debt will decline as a share of GDP. And notice again into the mythical medium term. We never talk about what needs to be done now. Medium term is one of those political statements which means, well, it won't be in our parliament, so we don't need to be held accountable in this parliament. We'll just kick it down into the next parliament, because maybe we won't even be in government anyway. So this is, being pushed back to projected figures for 5 years' time, so 2027 or so. Now, these will be published supposedly at the same time as the government sets out this plan on the 17th of November, which of course could get pushed back equally. And I mean, so the financial markets will see how they react, but there's claims, of course, that the government's going to have to lower public borrowing by anywhere between 50 and 60 billion annually. I don't know on what basis. And the question is, who's going to borrow anyway? Because increasingly, the United Kingdom, to me, and I don't think it's unfair to say this, looks like an emerging market, and that's being diplomatic. Given all the problems we have with printed money and manageable debt, the fact that we do have huge budget deficit problems, how there's no doubt the UK is suffering far more than it admitted with regards to issues of energy, with food price inflation and general inflation, which officially is over 10%, but probably is nearer 18, 19, 20%, because we always have to add about 8 to 10% to deal with reality. And of course, Sunak becomes Prime Minister, and okay, to most people outside the UK, they're going, how did that happen? He wasn't elected. Well, no, he wasn't elected. Okay, but that's how it works here. It doesn't make it correct, but that's how it is. So the fact he was shoehorned in after losing, of course, ironically, to Truss, which seems to have also been forgotten. He immediately comes in and they're on this austerity footing. Okay, fracking and shale is controversial, but 1 minute they're going, we need shale gas because we need to plug the gaps in our lack of energy resources. Apparently that's off, so they're going to ban or reinstate the ban in England for shale. Okay, some people will agree with that from an environmental perspective, but that puts massive strain potentially on the energy mix for the UK. And he's basically come out and is like a typical sort of conservative government who, when they don't balance the books, and it was their choice to do what they did and print, I don't know, hundreds of millions of pounds, billions of pounds, and then going, well, we have to claw all this back, which is never going to happen. You can't resolve all the problems with regards to printing money and all the problems we have in the broader economy, financial system, all the reality of the problems of the pound and the gilt markets, and why endless QE zero interest rate policy. As soon as you raise interest rates, you're going to destroy everything because the market's geared around endless cheap credit. As soon as you cut off the endless cheap credit tap, you're in serious trouble. We know this is just a statement of the obvious. And with regards to this kind of idea of austerity, what do we find? UK wages have fallen at the fastest pace since 2010. So real wages adjusted for official inflation actually fell 2.5%, over 2.5% in the year to April. That's the largest drop since there was over 3% decline around 2010, something like that. And therefore, the argument is that's just going to cause more and more pressure. So what does it mean in terms of tax hikes? Who's going to pay for these tax hikes? Is it going to be income tax? Is it going to be corporation tax? Well, there's no clear indication. But the worst point in any economic financial cycle is to raise taxation at this point in time. It's a complete disaster and will be a complete failure for all the reasons we've just highlighted. And when we sort of then factor in a broader sense to this idea that things can be fixed, the amount of leverage inside the entire financial system is so ridiculously out of sync with where it should be. And all the credit risk. And credit risk is now not only as it was prior to 2008 in banks, it's now in non-banks or shadow banking. It's growing exponentially and it's not decreasing. And there's all this leverage, it's all hidden. No one has any understanding. A lot of it's completely unregulated in some sort of weird quasi-asset management ecosystem. It's not viable. It's not feasible. You can't fix it. And therefore, the risk is that if they implement austerity because someone seems to have convinced them, or they've tried to convince themselves that's going to fix the problems, which of course it won't. It will just merely make problems infinitely worse. And what do? We're going to go back to the Conservatives when they were effectively stripping people who rightly should have got benefits because they lost their job or whatever for no reason. Okay, there's people going to argue to the contrary and say, we're talking about socialism. We're not talking about socialism. We're talking about a situation where if you have the risk of tens of millions of people in a cost of living crisis who simply cannot make ends meet, and it's no fault of their own, just because of escalating inflation and all the inflationary pressure and real wages declining due to inflation and the risk of losing jobs and the risk of rising interest rates. And okay, maybe some people are over leveraged and they're going to even be more over leveraged. Of course, there are all these factors that are true, but overall, there is no way of fixing this. And they're behaving as though somehow the only thing that matters is what the markets think. Well, the markets have no grip on reality anyway, and it doesn't really matter whether the markets think everything's okay, because reality is now becoming irrefutable. You can't print energy, you can't print food. We're having to deal with hard, brass sort of tax of reality, and this is not something that's just going to magically disappear, as they've managed to get away with it for far too long since the financialization of economies, which effectively, of course, started, as we said before, during the Thatcher-Reagan era. So the idea that Sunak's going to do, I think Sunak has to take a huge amount of responsibility for why we're in the mess now. When he was Chancellor, that's because where's the credibility for him to hold the position of being Chancellor? He became he was a candidate that got elected in 2015. He spent 7 years in politics. What does he know really about politics? Well, I mean, I made the point that Truss being elected was the worst political decision since Chamberlain in 1938. And of course, unsurprisingly, she didn't last very long. But with Sunak, whilst he's not as deficient as Truss is, and then people will say, of course, that Sunak's just a shoe-in and he's in because he worked in Goldman Sachs. Well, he left Goldman Sachs in 2004. He hasn't worked there for 18 years. Yeah, he worked in some hedge funds. I don't know what he did there. It doesn't really matter. But overall, I think the idea that he's some globalist shoe-in is not reality either. It's just that there is nobody in the United Kingdom who is in any way, shape, or form capable of being prime minister. But there's always going to be someone who thinks I can change things. I'll turn this around. I'll make a name for myself because that's what they think. But Sunak is in no way, shape, or form has any credentials or capabilities or ability, should I say, to make any lasting change because you cannot fix something that is terminally broken. I mean, what are you going to do? We're going to reduce the debt burden. How? We're going to by increasing taxes, which means we're going to cripple our economic productivity, what's left of it, which isn't an awful lot. And then what did Sunak come out and make the fundamental flaw where he's talking to Biden and going, yes, we support your moves to counter China. The last thing the United Kingdom needs to do is to be countering China. Ironically, the United Kingdom has survived to some extent because of the enormous amount of Chinese investment, particularly since 2010. I mean, this is just the statement of fact. And as we've seen today with Germany, as much as this, we need to counter China. What do we see? Costco's bought a 24.9% stake in Hamburg Port, and they've also, the Chinese have bought Elmos, which is a German semiconductor production company. Because the basic bottom line is the West cannot function without investment. Who's going to provide that investment? Realistically, it's only China. So on that basis, Britain needs enormous investment if it's to have any hope of resolving its long-standing fundamental problems. So by saying that we see China as an adversary, you must counter them, isn't going to attract Chinese investment. No, people can argue, I don't want Chinese investment. Fine. Well, okay, but who's going to invest in Britain because it needs enormous investment apart from having to fundamentally reset its entire economy, which means for us to become productive in a global sense in terms of industrial production and actually turning a pound into a pound and 10 pence. We're going to have to pay we're going to have to pay Chinese wages. Well, how can we pay Chinese wages in the way our economy and financial system is structured? We can't do that. It's impossible. That's why, in inverted commas, and I have to be careful because when you mention the word reset, people have an aneurysm and think it's the World Economic Forum, and it's not. It never was, and it never will be. But fundamentally, we have to change the entire structure of how the West operates because we're totally economically unviable. We can't consume anymore. We can't keep paying higher wages because we're becoming more and more uncompetitive. And effectively, we've just reached the end of the line. We can't keep depending on endless cheap credit to prop everything up because that's not viable either. So there has to be this fundamental radical overhaul. And there's no one in the political system who has any understanding of what that means and why it's going to happen, whether they like it or not. And there's going to be a situation where there's going to have to be a radical rethink over long-term government policies in the West. I'm not advocating that we should have a Chinese system of 50-year plans or anything like that, but we need to start having longer-term plans to rectify some of the fundamental problems we have, rather than politicians just trying to get elected for another parliamentary term with no interest or actually any understanding of what's needed to fix these long-standing fundamental problems that really started decades ago, but particularly in the financialization of economies and the idea that that's where all the wealth is produced, which of course none of it is. We have to change that fundamentally, and at the moment we're so far removed from that reality. We're diametrically opposed to the direction we're going in. So everything, policy decisions now, are just the old failed policy decisions. Oh, we've spent too much money. Now we have to, make cuts. We have to have tax hikes. We have to cut public spending because that's the idea that we're going to resolve all the financial problems. I'm going to resolve our economic problems by actually doing the exact opposite that you've done, particularly since 2008 with endless cheap credit. Now we're not doing that anymore. but magically that's going to fix everything. I mean, yes, endless cheap credit doesn't fix anything. In fact, it makes things infinitely worse. But turning the taps off completely and going, well, we're just going to cut spending to the point that we're actually going to destroy what's left of the economy, and in the process is just ridiculous. But it's just what you expect to see, because these people are not capable of understanding what the fundamental problems are, and they frankly never will be.
Yeah, they've been I think blocking the market with their policy of zero interest rates, deficit spending, because you said the markets are now in charge, but I don't even think the markets are real. And every time the markets try to get real, like I think they were trying to get, they were saying a month or 6 weeks ago that we've got too much debt, that rates have to rise. What happens? Well, the Bank of England comes in and intervenes. So maybe talking about markets, we could conclude by looking at what's happening in the US, because recently I think the US Treasury did a survey of market participants. They kept it anonymous, and their question was whether what happened in the UK could happen in the US. And we know that since March 2020, and even before that, with the repo crisis in 2019, the Treasury market has had a lot of problem with liquidity. Maybe you could talk about that as we conclude our chat.
Yeah, for sure. I mean, yes, there's no doubt that there is huge ongoing problems with liquidity and just the treasury markets blowing up. And I mean, the whole rising dollar thing is interesting for a number of reasons. I mean, this is like particularly people focus on the dollar index, which, I think there's a whole bunch of different perspectives on. For me, there's just massive manipulation in terms of trying to convince the world that the strength in the dollar, and of course, this is having serious effects, which is very actually damaging for the dollar itself. I mean, we'll try and keep it quite brief, but obviously we know the Fed's had all these interest rate hikes. That's caused a lot of gyrations in global markets, and then central banks have been trying to prop up domestic currencies. I mean, the yen was one example of this, which fell to its weakest level against the dollar in over 30 years and was actually down over 20%, this year. Now, the interesting thing is, in the process of governments going, well, because of all this hike in Fed interest rates and the weaknesses in our own currencies, we're going to have to stabilize our currencies and try and defend against these interest rate hikes by the Fed, which in principle means the dollar's just got stronger and stronger. But actually, ironically, the fact the Fed has kept raising interest rates, and it's actually not making any difference to inflation, because inflation is a structural problem. And it's not an overheating economy, because we know the US actually was in recession because it was 2 negative quarters. And even though, of course, in reality, GDP is a complete work of fiction, and in reality, GDP is minus 5, 6, 7%, and it's probably hardly ever been positive since 2008 in reality. But what the situation is, and nations have sort of wised up to this, they've gone, well, we can keep trading in dollar terms, but given we have local currencies and we need dollars to trade with each other, we're getting hammered because of the weakness of our local currencies. I know, let's just trade in local currencies, which is increasingly happening. And they're going, well, actually, that smooths out some of the problems we're having with the stronger dollar. So it's actually weakening the usage of the dollar internationally. And yes, some of that's being driven, of course, by sanctions. I mean, we've seen like India and Russia trading in local currencies like rupees and the ruble. Of course, that's absolutely true, and it's the case. And what's very clear is, as well, is that nations are looking at this going, well, it's too expensive for me to have dollar denominated debt. So I'm going to look to raise money in local currencies in other markets. And I'm not going to have dollar denominated debt. That's also increasingly becoming the case. It doesn't mean the entire dollar denominated debt market's dried up and doesn't exist. Of course, that would be ridiculous to suggest that, but that is certainly happening as well, which is equally damaging for the dollar, because indirectly, this strength in inverted commas of the dollar relative to maybe currencies like the euro, yeah, and the pound, etc., is actually having a serious sort of side effect of increasing de-dollarization, because nations are going, well, here's the thing, I can trade with China in the yuan and I don't experience that same sort of currency volatility, so let's not trade in dollars with the Chinese. Let's trade in yuan. China's happy with it, they're happy with it, and the two participating nations in this bilateral trade agreement or arrangement are very happy with the outcome, and it helps to iron out problems that there is in relation to their currency sharply declining against the dollar. I mean, the rupee is a good example of this. So, and also, I think a point worth making, there's a lot of this idea that that this strengthening dollar means that everyone's piling into now buying US assets, and all this money is coming into the US and strengthening the dollar. Well, actually, if more and more money returns to the United States, that actually creates inflationary problems, because the one thing is, we've always said, is if the world rejects the dollar and then eventually more and more of the dollars will return home to the US, this is not good for the dollar. It's certainly not good for US inflation. And so there's a lot of ideas out there that somehow this is always indicative that the US economy is on a far stronger footing than the rest of the world, which of course is equally nonsensical. So overall, from my perspective, yeah, it doesn't matter the dollar index. If you get to 150, I don't think it ever will get to 150. But it doesn't matter, because in a sense, all this is doing is that it's going to mean that if you're importing goods where possible, and it's not always feasible, you'll just trade in local currencies and avoid using the dollar as much as possible, which will help to curb some of the inflationary problems and actually help to stabilize economies inside, particularly the global south, which on the back of whatever people's perspective of the Ukraine war is, because of the sanctioning of Russia's central bank, excluding banks to all intents and purposes from SWIFT, meant nations start to go, well, actually, we don't want to trade in dollars anymore. We don't want to hold dollars. Well, here's another good reason why we wouldn't want to do that. And also, in a sense, the irony is, if you look at the surge in the value of the dollar, it's making it more difficult for foreign borrowers who have dollar-denominated debt or want in the future to repay the loans. They're going, well, I won't do this. I'll do it in a local currency, and actually it's going to be far more beneficial for me to do so. And you're starting to create an ecosystem outside the dollar. And this is something that people who are sort of very pro the US dollar don't seem to grasp or understand. And the other thing is that there's the idea that all debt denominated in the US currency has to be paid in dollars. Well, it doesn't. I mean, that's another kind of myth that needs to be knocked on the head. It can be paid in other currencies. It depends on the arrangement of who is the creditor, who is the debtor. And we need to sort of get away from this idea that somehow the world increasingly needs more and more dollars, when in fact everything's pointing to the fact that more and more of the world is moving outside the sphere of influence of the dollar, because they realize it's advantageous to do so for the reasons we've just highlighted. And of course, the other point worth making is with regards to the idea that the dollar's getting strong, and therefore you're going to increase more and more of a need for nations to hold dollars, because they're going to need more and more dollar debt to service their existing debt. Well, actually we're seeing a lot of evidence that doesn't support that viewpoint. And therefore, I think this is actually very detrimental. Now, the question is, will the Fed keep raising interest rates? I mean, and really at the end of the day, they can raise interest rates and blow everything up, or they can lower interest rates and pump QE to infinity. And the risk is, as they cause more and more volatility in the treasury markets, the risk is, and if they go for QT, they're going to cause a repo crisis and have to completely reverse course and do what they did during the last repo crisis and bail everything out, because there was enormous amounts of liquidity and collateral issues, and they'll have to just bail everything out again. So that's a whole credibility issue. So ultimately, from my perspective, it doesn't really matter how the journey is, the destination is the same, it's just total wreckage. So, because everyone knows the United States cannot sustain high interest rates. It's not possible because their entire financial system is predicated on endless debt. Their entire economy needs endless cheap credit. Well, if you start to restrict access to endless cheap credit, you're going to blow everything up, which is why in 2020, when the pandemic started, they just went, just bail everything out, just print trillions, because otherwise everything's going to blow up. So it's not sustainable to have raising interest rates in an environment which is being supported by zero interest rates and endless cheap credit. But equally, the flip side is, if they then panic and have to resort to QE, okay, the credibility issue is one thing. But at the end of the day, for me, that's kind of an irrelevant. I don't see how the Fed has got any credibility anyway, given its the decisions and actions it's made since 2008. I mean, it doesn't have any credibility. The issue, more importantly, is if it decides it has to resort to lowering interest rates or freezing interest rate, and we don't know what they're going to do, and people like to debate on it. For me, it's not really that, honestly, that concerned what they do. But if they do start to lower interest rates and they then have to resort to endless QE again, then all they're going to do is just create more and more inflationary pressure. And the US simply cannot sustain high inflation either. So at the end of the day, it's just this slow grind into dust. And the idea that normal interest rates in the present environment can exist is just not reality. The idea that somehow we can rectify all the structural problems to do with inflation, and in a broader sense, the economy, and how the US can turn around the fact that it's going to run endless deficits annually for well over $1 trillion and growing it, then you cannot fix that. How does it fix all its unfunded liabilities? And if anyone believes the US dollar's in a position of strength, the reason the US wants the war to carry on in Ukraine with Russia, the reason it wants China at war with Taiwan, the reason it's now making threatening overtures to North Korea with regards to all these missiles that it keeps testing. And yeah, it's been doing them for the last 2 years, but suddenly it's a problem. And we need to protect Japan and South Korea, and if needs be, we may have to resort to the nuclear option. And the reason they're doing all this, and of course, trying to also, even though it's failing, have another attempt at a coup or a revolution in Iran. The reason they're doing all this is because the United States as an empire is on its knees. It is on the edge of oblivion. It's on the edge of the end of the empire as it was known, the hegemony, and that includes the dollar. That's why the US is going to the extent it is. Why? Because China and Russia is perceived, from their perspective, and rightly so, as they're kind of ambassadors for the multipolar world, for a different financial system, a different economy, a different way of conducting multilateral trade, globalization, dare we say that word, because people hate it and for justifiable reasons, but a whole different way of doing it. And the US knows they pose a serious threat. And in fact, by implementing it, you're going to kill US hegemony and kill the US dollar. And that's why the US is hell bent on taking these risks, okay, to some degree, but there comes a point where how much further they prepare to push the red line with Russia, that's a whole different conversation. But this is why we are where we are, because it doesn't matter how strong, in inverted commas, the US dollar is. I think a lot of it is manipulation. A lot of it is to give the impression that there should be confidence in the dollar, that you want to hold dollars, you want dollar denominated debt, you want dollar denominated assets, because it's a drive to try and convince a rapidly disbelieving world, particularly the global south, that you would actually want to hold anything dollar related, not least because if you do, your central bank might get cut off out of SWIFT. You might get all your forex reserves stolen, or maybe your treasuries. And that's the other thing in actually strengthening the dollar and allowing this to happen. You're actually forcing nations to dump US treasuries. I mean, the US would desperately like nations to have currency swaps and not dump treasury. The nations are going to dump treasuries, not least to defend their currency, but also because if you've got these wildly gyrating bond markets, why would you want to necessarily continue holding bonds? Okay, you might already take a massive haircut on the price. You might have lost 20, 30%, but you could lose even more in the future. So they're actually their policy decisions for accelerating the demise of the dollar. And just the notion that the dollar index is at 110 or 115 or whatever people perceive does not indicate to me any strength in the dollar. It's just a figure of merit that says, well, notionally speaking, and I think there's huge currency manipulation, and we know there's massive currency manipulation in favor of the dollar just by the gold and silver markets, because in dollar terms, everything's been done to suppress the price. Because if gold was $2,500 an ounce tomorrow, we've said this before, the dollar would be toast, because everyone would be piling out of the dollar into gold. Quite simply, the institutions would see that as a signal that the dollar was in serious trouble. By suppressing the price, people think that the dollar's okay. And again, it's a confidence. It's just about confidence. The dollar is only a confidence trick now. And that's why they don't like China and Russia, because Russia and China are exposing the confidence trick and saying, you don't want to hold dollars. You want to actually get out of dollars. You want to trade in non-dollar terms because it's hugely advantageous. And it doesn't matter then what your local currency is in dollar terms, because you're no longer trading in dollars. So these policy decisions are ultimately detrimental, and continuing to raise interest rates, apart from what you might do to the swap markets in terms of interest rate swaps, is one thing. But also in a broader context, this is not good for the US economy to have hiking and spiking interest rates, because, as we said, and the UK is the same, and Europe is predicated on the fact that you need very low interest rate economy, because otherwise it simply can't function, because it only functions by endless cheap credit or money printing.
Paul, it's always great to speak with you. We always get some very interesting perspectives. And yeah, we'll be speaking again hopefully soon. And just wanted to thank you. And also maybe before we go off the air, maybe you could tell the viewers where they can find you. And yeah.
Well, yes, thank you. Well, obviously, yes, you made the point first off on Twitter, which is the Sirius Report, which, it's kind of, we started the year with about 6,000 followers, and we're now over 108. It's ironic it took a war to suddenly galvanize a huge amount of interest, even though we've said exactly the same things for many years, but it is what it is. So sometimes things just happen, and there was a big sort of spike in interest, and yes, you very kindly subscribe to the podcast, and we do the equivalent of 5 a week, but often because of the content, we bolt 2 together and just do 2 as one, because sometimes the subject matter that you just need to tie together, and trying to do it in 20 minutes is not possible to do it. So, and also from our perspective, it's easier than doing 5 20-minute ones a week. So yeah, we do that pretty much all year round. Even when we were away recently, we put a week's worth out in advance. And we cover all geopolitics, finance, and economics, and tie all these things together as these 2 worlds coexist. One, sadly, in terminal decline, the other one is growing very rapidly. And again, this is part of the multipolar world, why the US sees everything that stands for the multipolar world as a threat. Because anything that opposes the United States is a threat, or even if they're not opposing the United States, but instead of understanding that it would be far more beneficial for the US to work with this environment and understand the world is rapidly changing. And the more they try to prevent it, the more they're digging a hole for themselves in the process. But unfortunately, that's what happens as empires decline. So that's the point of the podcast. And we think it's extremely affordable. And yeah, you're right, it's less than $1 a week in equivalent terms, particularly if you subscribe for a year. So, and we've never put prices up, and as much as possible, we'll try to avoid doing that, so we keep it cheap. And actually, we have to thank you as well, Mario, because often when we do something with you, we get quite a lot of interest and subscribers joining. So you've been very helpful in that regard. So we appreciate the opportunity to come on, and we also support your work, and we recommend people listen to you, because I think you make some, on a literally daily basis, extremely interesting and relevant points, and it's and you do it in a way, I think, that is very sort of grounded, and not what my pet hate is people who like to entertain people, because entertaining is of no value to anyone in an environment where we've been entertained by governments in the loosest sense of the word for far too long in every capacity. We need to move past being entertained and to actually be informed. And informed can often not be particularly palatable. It might be fairly dull in some ways, but it's better than being entertained with ideas of things that are happening in the world which simply aren't reality and have no basis in reality.
Again, Paul, thank you very much, and I'll talk to you later. Take care.
Yes, and you too.